2017 was the year that cryptocurrencies really landed in the public consciousness. Up until then, it had really been a little bit about the tech people. But that was the year that it really started to make headlines. And so you can see that if you look at the Google searches for the word Bitcoin. So you can really see that starts to change in 2017. So what's driving that interest, do we think? Might it perhaps be the price of Bitcoin? I think it might be. So that's 5 years' worth of the price of Bitcoin, the same scale as on that previous graph, and you can really see the change in 2017. In the start of 2017, it was around about $1,000 US. By December, it had made it up to $20,000 US before starting to fall back down. And so as a result, we see this public interest. We start to see the headlines being generated. So, should we be all in, as this opinion writer thinks? Or perhaps we should all be running the other way with a slightly smug, I told you so side to it, as this opinion writer thinks. Now, these two opinions were published within just a couple of weeks of each other within the Financial Times. What I'd like to suggest today is that maybe there's another way of thinking about this. So instead of thinking just about the value of Bitcoin, instead of focusing on the hype, let's instead look beneath that at the technology, the value of the technology that underlies it. Instead of thinking about fortunes that are there to be made and fortunes that are there to be lost, let's think instead about the potential of the technology to change the way we do things completely. So that's what we're going to do today. And we're going to start by thinking about email. So email's been around for, well, a long time, but in the last 20 years, it's totally changed the way that we communicate, because now you can send a message and you can send it to anyone, anywhere in the world. It arrives instantly, all of that sort of thing. The important thing about email is that when you send it, you send a copy. So you keep the original message and the other person gets a copy of your message. And that's fine when we're talking about sending a document. It's fine if we're sending a photo, but I think we'll find it's not fine if we're sending currency. I'm pretty certain if I send you an email of $100 and I keep the original and you get a copy, you're going to be pretty unhappy about that situation. And so that's why we see every time you make a transaction online, there is a large financial institution stood in the way. You basically send an instruction that, whether you use PayPal or whether you use your credit card online or whether you're using a wallet or whatever, you're basically sending an instruction for your bank to pay somebody else's bank. Your bank account goes down, their bank account goes up, and a bank or a government agency, or these days perhaps Google or Apple or Facebook, are standing in the way, making sure that that happens. Because this idea that you keep the original and send a copy, this is a classic problem in digital payments. It's called the double spending problem. It's like one of the main problems in the area. And so back in 1999, the economist Milton Friedman said this: one thing that's missing but will soon be developed is a reliable e-cash. And he went on to describe what he meant by that. That on the internet you can send money from person A to person B without those people needing to know who they are. A doesn't need to know B, and B doesn't need to know A. And he's basically describing the digital equivalent of handing over physical cash. If I give you a $5 note, you don't need to know who I am. I don't need to know who you are. It's just a transaction that happens. We don't need a bank to stand in the middle of that transaction. Friedman died in 2006, so he didn't get to see his prediction realized. But in 2008, Satoshi Nakamoto, who is this mysterious person or group, we still don't know who this is, came out with this white paper, Bitcoin, a peer-to-peer cash system. And the first line of this, if you read it, this is basically exactly what Friedman was predicting, a purely peer-to-peer version of electronic cash that would allow online payments to be sent directly from one party to another without going through a financial institution. It's basically exactly Friedman's prediction. And so in 2009, Bitcoin was born, the world's first cryptocurrency. And as many of the technologies you've heard about in the last couple of days, in its early days, it was a bit of a non-thing. So by the end of 2 years, just a few thousand people were using it in this really tight technology community. But in the years since, that use has expanded exponentially, and now millions of people across the world use Bitcoin, and hundreds of thousands of transactions are made every day. Thinking about that underlying technology, though, it's called blockchain. I'm sure you've all heard of it by now. And that technology is the thing that allows any individual to go on there and make a payment. So anyone can go online and make a Bitcoin payment. And that transaction is secured using public-private key cryptography. It's sent out to this huge network of users, each of which is keeping a copy of that ledger. Transactions every few minutes are then wrapped up. They're put into a block by someone called a Bitcoin miner. They're put into a block. They're verified by the network as being correct. And then they're attached to this chain of blocks before it. And the really important thing here is that every block keeps the signature of the block before it. And that's the thing that means that history can't be rewritten. You can't go back a number of blocks and change it, because if you did, you'd have to change every block since that time. And that's really, really difficult to do, and basically impossible to do without everybody becoming aware of it. This is the graph of the amount of power that is being used to secure the Bitcoin network. This is a classic exponential graph. And that amount of power, so what happens is the Bitcoin miners provide power to the network. They are competing against each other using computer power to create the next block. And they get paid in Bitcoin for doing that, roughly in proportion to the amount of power that they're providing to the network. Now, this graph, this is a couple of weeks old, so it'll have already changed. But at this point, it stood at 24 exahash per second. Now, let's put that in context. If you were to take the world's largest supercomputer and add it to this network, it would make basically no difference whatsoever. If you were to take 10 million versions of that world's largest supercomputer and add it to this network, you might get to 1%. It is an unthinkably large amount of computing power that is being used to secure the Bitcoin network. And that, of course, is both a good thing and a bad thing. So it's important, if we're going to have cryptocurrencies that we can trust and use online, it is important that we have security for those. And that, at the moment, is mostly provided using computing power. But it also uses a very large amount of energy. So we can accurately say how much power is being provided to the network. We can only estimate how much electricity is being generated to do that. But the estimates are that Bitcoin network now uses the same amount of power as a small country. And that obviously has issues that go with it. Now, there are potential ways forward that can change that. But right now, this is where we are. This is one of the biggest downsides of Bitcoin and similar cryptocurrencies. With that in mind, however, here we have a technology that allows us to make secure payments. It's tamper-proof. Anybody can use it. It doesn't require a central authority. This is that same Google search, 5 years' worth of the word blockchain. Now, you can see that same rise in interest. But this is a little bit steadier, because this is not so much driven by the price of Bitcoin or the other cryptocurrencies. This instead is being driven by people starting to understand the power of that underlying technology and where else it can be used. Because at its heart, blockchain is all about trust. It's about building trust. And in our digital lives online, we have so many areas in which we need to build that trust. We need trust in ownership, and trust in quality, and trust in process, and we need trust even in ethics and values. And up till now, our only option for that has been to use large institutions to provide that trust for us. And now, sometimes we've even been having to just do without it. And now we have, hopefully, a different way of doing that. So what I want to do is take you through some of the ways that that can be used. Any asset which can be uniquely identified can be registered and transferred using a blockchain. And that sounds simple, right? But there are so many different ways that this can be used. Here's a few examples. The first is financial services. So the trading of financial shares. There are at the moment lots of institutions involved in keeping that whole thing secure. So you have exchanges and brokers and registrars and custodians and central counterparties and all of that kind of stuff. And these people are now looking at, well, is there a way not to do something completely new here, but to take this technology and make our existing systems more efficient? Now that's interesting, right? Because blockchain is actually uniquely suited to completely disrupting industries that rely on a central authority. And so I think perhaps behind this, you might also have a little bit of these institutions starting to realize that their business model might be under a little bit of threat. Here in Australia, ASX has announced that it will completely replace its CHESS settlement system with a blockchain-based system. Now, they're not the only ones. Of course, NASDAQ, DTCC, the London Stock Exchange Group have all announced that they're moving in the same direction. Hundreds of these institutions, registrars, brokers, etc., doing the same thing across the world. Global supply chains, and particularly shipping, is another area that has all these different parties working within them. So you've got the suppliers, and you've got your shipping companies, and you've got the banks providing the finance, you've got ports, and you've got customs, you've got border authorities, and that's before you even get to the customer and what they want to actually do with the goods. It is this big mess of paperwork and delays and uncertainty. And so global shipping giant Maersk has decided that they want to do something about this using this technology. And what they're doing is a really interesting process. They're trying to bring the industry around them so that this will be something that is owned by the entire industry and that everybody can use. And that's one of the key things about blockchain-based systems. They can't be done by individual companies themselves. They have to be done by a community. And this is one area that we're really starting to see that. But again, this is something that they're looking at, something that's already, these are assets that are already registered in some way, and so they're just making existing systems more efficient. What happens when we start to think about assets that have never been registered before? What about food? What about medicine? What about jewelry? What about clothing? We've never been able to register those at individual asset level, not in any sensible way. Now we've got a number of organizations doing this, and Everledger do this for high-value assets, and Louise Mercer from Everledger is actually coming on straight after me. She's going to talk about the impact that is having for people and for business. Provenance are a social enterprise based out in the UK. They register food and clothing on their blockchain system, and that's really important for consumers, because it means you can now go and you can check, is the fish that I'm about to eat, has that actually been sustainably caught? This piece of clothing that I'm about to buy, what is it made of? Where was it made? What are the materials? What factory was it made in? What are the conditions like there? You can check all of those things online. And that transparency over our supply chain becomes really important when we start to think about safety. So, is there a way that we can tell that vaccines have been shipped, kept at the right temperature, right throughout the supply chain? Is there a way that we can tell when we find out that food is contaminated? Is there a way to tell quickly where it is? And this is where Walmart have started working. They're bringing their suppliers around them, again, in this kind of network effect. There's some global giants in there. We're talking about Nestle and Unilever and companies like that. And they're looking, how do they track their supply chain real time, so that when they get a notification of food contamination, they can find it not in days, but in seconds, exactly where it is. Digital identity is another area that blockchain technology can really help. Now look, at the moment, this is completely hopeless. Right? If you go online, you want to identify yourself online, you want someone to know who you are, your age, your address, that sort of thing, you're having to use physical identity documents to do it. Particularly if you want to do something like open a bank account online, you're almost certainly going to have to send a copy of a physical identity document because of the anti-money laundering laws. And it's slow and it's cumbersome, and it really impacts the online experience that we're used to having. But just think about that online experience for a second. Now, this is the sort of thing we're starting to see. So what about our privacy here? Now, are we swapping this online experience, the quick ability to identify ourselves via Facebook or Twitter or Google, for giving away our data to these companies? What if there was another way of doing that? So the other thing that we need to think about when we talk about digital identity, or identity in general, actually, is that we often give away way more information about ourselves than we need to. So think, for example, if you want to rent a car, or you want to even go into a bar and just be able to prove your age. Okay, we often do that with physical identity documents that give away lots of information about us. But actually, the bar only needs to know how old I am. They don't even need to know my date of birth. And the rental car company only needs to know that I'm able to drive. I have a license to drive. They don't need to know all this other information about me. So what if I was able to use blockchain technology to keep control of my own data, to split up my identity into these lots of tiny bits, my first name, my surname, my address, my date of birth, all of that sort of thing, my qualifications even, and have those verified by the relevant institutions. So my date of birth might be verified by a government agency, my qualifications perhaps by my school or my university. And then it's in my control, and it's kept confidential until I want to open it up. And then I just give just the little bit of my identification information that that person needs. And they can see that it's been verified before, so we don't need to keep going through this anti-money laundering thing over and over and over again. So there are companies out there that are doing this. This one, there's lots of companies out there, by the way, doing this. This is just an example. This is Civic, based out of San Francisco. And here in Australia, a piece of work was done about 18 months ago that looked at this type of digital system for identity. And this piece of work showed that the benefit for the Australian economy would be $11 billion a year for just going to this type of system. And that's from ironing out all of these inefficiencies that we're talking about. It's from reducing fraud online, but it's also from getting more people engaged online because it's easier to do. And that's before we start thinking about going worldwide and the impact that this could have on the 2 billion people worldwide who don't have any form of formal identification document. Some blockchain technologies allow you to store more than just transactional data. You've heard it mentioned a couple of times already over the last couple of days. Some blockchain technologies also allow you to store small programs. And those small programs then run just based on a set of pre-agreed conditions. The best known one of these is Ethereum. And I mean, to give an example, you put an asset or a currency or even a piece of information into this program, it runs to this set of conditions, and it passes that information or asset on at the end. So think about, for example, a weather insurance contract. You put the premium into the contract, and you agree up front what data you're going to use, and is it rainfall or is it temperature? What is it that you're interested in? And at the end, the contract itself makes the payment. I mentioned earlier about global supply chains and shipping. About a year ago, this experiment was done. This is Commonwealth Bank of Australia and Wells Fargo. And what they did was they took a shipment that was going of cotton. It was going from the US to China. And into a smart contract, they put a monitor for the physical arrival in China of this shipment. And when it physically arrived, and the proof of that arrives in the contract, the title to the cotton transferred automatically, and the payment transferred automatically. So again, starting to work on making our existing systems more efficient. But smart contracts open up entirely new ways of doing things. One of the examples of that is a local-based blockchain company, Powerledger. They are looking at, amongst many other things, by the way, that Powerledger are doing, they are looking at rooftop solar and how can you then sell your rooftop solar to your local community. You heard, I think, from Ramez Naam yesterday about the fast-dropping cost of solar. This is one of the ways that you can spread that benefit around the community. So it's not just about the people who can afford to put rooftop solar panels on their houses. This is one of the ways that we can have that kind of peer-to-peer interaction. Another is Golem, the world's supercomputer. So this does the same thing, but it does it for your spare computing power. It basically takes your spare computing power and it gives it to people who need it for perhaps rendering computer graphics, as an example, things that use a lot of computing power. And this would never have really been able to be done in the past, because it's very complicated. You have to match somebody's computing power with the person who needs it. You have to work out how much they've used. You have to make the payment happen. It would all have been incredibly complicated before we were able to do this in a smart contract. So this is how we start to see peer-to-peer interactions happening, and perhaps the middleman not so much being needed. And so what does that mean for organizations who have set themselves up to be the middleman in these transactions? May we perhaps be seeing the beginning of the end for those sorts of organizations. What happens, for example, if I can put my rental payment, I'm a traveler, I put my rental payment into a smart contract, and the homeowner puts their digital key into that same smart contract. And at the end of that contract, perhaps we can both put a transparent rating into that contract. Why is there any need for a middleman in that anymore? So perhaps, Uber and Airbnb might be needing a bit of a rethink in the future. Now, it's impossible, basically, to do a blockchain presentation anymore without talking about that other area of headline and hype, the initial coin offering. So these are basically, these are areas where companies or organizations issue a digital token or a coin in return for a payment, and right now, they are mostly being used as ways of raising capital. And we're seeing them used a great deal. There was a $3.5 billion worth of money raised using ICOs last year. The largest one, $250 million. The first question, though, that you really need to ask when you start thinking about an ICO, and these, by the way, these are essential to the way that we move forward with blockchain technology, because if you think about the types of systems that I'm talking about, these peer-to-peer interactions, well, they're peer-to-peer, there's no middleman, there's no one clipping the ticket on the way. They are moving towards very, very low cost. Who on earth is going to pay for that? Who is going to be the investor that wants to invest in that company? And so these are how these types of systems get built. But the first question you need to ask is, what is it that you're buying? What is this digital token or this coin? Because in the traditional world of finance, that's really obvious. You give the company some money, you get some shares back, and you own a portion of the company. Not so much with ICOs. So here's the 5 possible options that you might be getting when you buy a token in an ICO. Equity tokens are, in fact, very similar to that we've just described. You get perhaps voting rights, you get a share in dividends, you get effectively a tokenized share of the company. But they're also quite rare. We haven't seen very many of these yet. They're just starting to come through. There's been a couple in the last couple of months. And what's happening is blockchain companies are having to get used to the idea that they will be a regulated issuer of securities if they do this. That's why they haven't really happened that much yet. Then you have enterprise tokens. So this is like an equity token, but perhaps you might just get a share of the profits in a particular project. Or you might just get a share of a profits or a dividend over a certain amount of time. So similar, but not quite. Then you have asset-backed tokens, and these are exactly what they sound like. So you might get ownership via a token of traditional asset like gold or land or even currency, fiat currency. Or you might get a more speculative asset. So you get a token that gives you a share of the mineral that's going to come out of a mine that hasn't been started yet. So this is a way of online owning and trading those underlying assets. And then there's utility tokens, and this is probably the majority of what we've seen so far. So this is a token that allows you to access in the future the services of the company that's issuing it. And Powerledger, who I mentioned earlier, they had a really successful ICO last year, and their tokens, among other things, allow you to access their decentralized energy exchange and buy electricity. So we see lots of tokens of that type. And then the final version is just cryptocurrencies. So these are things that don't have any other use than to be a store of value or a payment mechanism. You also hear those referred to as intrinsic tokens. Now, I genuinely believe that we will reach the stage where ICOs are a standard and regulated mechanism for companies to raise money. But we are absolutely not there yet. And this is one of these situations, I think, it's like Kyla spoke about on day one, where you kind of have to hold 2 different things in your head at once. Because ICOs, the cryptocurrencies and the digital tokens are absolutely essential to the way most of these businesses are going to operate. They're required for the platforms that they're operating on. But the way they're being issued, the ICO, is at the moment pretty much entirely unregulated. And so that causes us a bit of a problem because, to be honest, it has a tendency to attract what we might call the wrong type of entrepreneur. And it also allows relatively unsophisticated investors to be taken advantage of in this market. And sometimes we see what are just completely outright scams. So this company Confido, which happens to mean I trust, ironically, in Italian, they did a relatively small ICO at $375,000 and then just promptly disappeared with that money. And it seems likely now, unfortunately, from a couple of weeks ago, that the Benebit team, who did a much larger ICO, $4 million, have done the same. Now, obviously, not all ICOs are scams, not even most of them, right? And I'm not trying to say that at all. But even if an ICO at the moment is totally legitimate, I would still advise a level of caution, because most of these companies are brand new startups. Not all of them. Again, Power Ledger, who I talked about earlier, they're an existing business with customers and with revenue and a market and all of that sort of thing. But the vast majority of people doing ICOs right now are brand new startups with nothing more than an idea and a white paper. And here's some news for you. Most startups fail. The vast majority of startups fail. We already know this. And in fact, by giving them millions of dollars up front, we may, and rather than them going through the standard stepped financing process, we might actually be making this worse. And so, this is the point at which I think we need to think beyond the hype. So I go back and encourage you again. Think beyond just the fortunes to be made or lost. Think beyond the hype and the headline, and instead focus on the potential for this technology to change the way we do business for the long term and in the future. Blockchain technology is at the moment, it's version 1.0. This is very early stage technology. It has problems like electricity use and scale and speed, and those problems will take time. There are technological solutions, there are governance solutions, as Nathaniel was talking about on the first day. These are going to take time to work their way through. But as we move more of our digital lives online, blockchain technology has this opportunity to help us do things in a totally different way. It has the ability to help people access online services who have never had access to them before, and it has the power to help us to build and maintain trust online. So please, look beyond the hype. Thank you very much.